Well, hello. It's good to be back with you again. I'm Bohnsack, President and Head of Portfolio Strategy for Strategas, Baird's investment strategy arm. Last week, my colleague Jeanette Lowe walked through some of the legislative outlook and investment implications of the new Biden administration. So it's been a few weeks since we spoke directly about the markets. As we talk to investors, the number one question is, are we in a bubble? Sometimes it's rhetorical, but most often investors are looking aghast at the continuation of decidedly positive price action, in combination with rather frustrating headlines about the steady march of the virus, particularly in the face of persistent vaccination hurdles, and a growing sense that risk asset prices, particularly equities, may have run a little too far, a little too quickly. This week, U.S. real GDP for the fourth quarter missed Wall Street estimates, and at the same time, certain high-traffic internet message boards resulted in single stock increases of as much as 1,000% in just a matter of days. So something seems a little out of line. Are we in a bubble? Interestingly, few of the items on our Strategas bull market top checklist, which we showed you late last year, are approaching the worrying levels typically associated with a bubble or the end of a bull market in stocks. Inflation remains low, corporate credit spreads are relatively tight, even earnings revisions continue to be revised upward. And the Fed remains, as they reminded us earlier this week, fully prepared to remain accommodative for the foreseeable future. Now, we'll admit, IPO activity has gotten a little frothy, particularly with the convergence of the public and private markets through the SPAC phenomenon. And the S&P 500, a decent broad market proxy, trades almost 15% above its 200-day moving average. So it would not surprise us at all if sophisticated players started to take some risk exposure off the table and allowed the market to reset before moving back in. Consider the readings on this sentiment dashboard from our technical strategy team. 3 of the 7 measures of market sentiment are approaching the top of the range, and this can make professional investors nervous. It's the same reason we pay as much attention to your asset allocation plan. It allows us to navigate periods of volatility or unease without worrying about the impact on your long-term goals. So while we may be in the midst of a pullback, are we in a bubble? We'd offer 2 items to consider. The first is that we see few signs of credit stress in the market, which is encouraging, given some of the areas of recent weakness like banks or seen in previous periods when hedge funds fall victim to short squeeze, as we saw this week. And the second is valuation. And while historically it has not revealed itself to be the best timing tool, as we can see in this chart, crossing price earnings multiples and interest rates, the specter of speculative excess can persist for a while and at far more worrying intersections than we observe now. Given that it appears the building blocks have been laid for a cyclical recovery in activity, demand, output, revenue, and profitability, and while the economy's transition from recovery to expansion can prove jagged, we'd stay the course for now. We'll stay on the lookout for unhealthy excesses, and until then, stay healthy yourself, think long term, and know that the Baird team is here to help you however we can. We'll see you again soon.